The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments, in your retirement. On the show, our show is all about building up wealth and understanding the world today. Our motto and our philosophy is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. Save aggressively and invest conservatively. Now, as usual, we just have a ton of stuff to talk about on the show this week. We're going to be covering some of the big changes with the Supreme Court, what's going on with the tariffs, what's going on with this buildup in the Middle East, what's happening there, what's happening with the markets, looking at some of these bigger issues out there to really understand what's happening in the world. And again, the world keeps moving along very, very quickly. It's very volatile, and if you're retired or coming up in retirement or saving for retirement, you've got to navigate through these changing times. And so we're trying to help you out. We want to bring that to you, and we're going to be talking about it here on the show. You know, one of the more interesting things, if you look at, we've really had a big sell-off in the tech stocks. And on the Max Out Savings Show for well over a year, we've been saying the tech stocks are too expensive. We threw out all types of numbers. We said based on PE ratio, price to sales. But then we went and looked at it, and we said that the market capitalization of these companies are in the trillions of dollars. And once the selling started, there wasn't enough money in the world. When you got the Mag 7, probably well over $10 trillion in market cap in a $23 trillion economy. Where's the money going to come from when everybody wants to sell them? And in addition, we then pointed out that the Mag 7 were about 32% of the whole S&P 500. And if you really added up all the tech stocks, some people really thought the number was closer to 44% of the S&P 500 was tech ranked. And so that really, it really brought up kind of some of the real issues. And if you look at something like Microsoft peaked back in July at about $552. And since then, it went up one more time to about $550 in October, and it's been all downhill. And now it's at under $400 a share, which is a pretty substantial drop. Any way you look at it on the numbers, it's very substantial. And 25-30% drop, and it's many of the other tech stocks. We all started out with AI was going to be such a boom, and a couple things happened. All of a sudden, well, two things happened. If you look at it, it was 100. Google came out and said, "Look, hey, we're going to be upping our capital spending." They're like, "How much?" Well, $185 billion for the year, and people are like, "What? Wait, this seems like a lot of money." And then Amazon, not to be outdone, said they were spending $200 billion. And so these big tech stocks at massive valuations because they were basically software stocks, and it really didn't have any capex in these. They had massive free cash flow. They used the free cash flow to buy back stock, constantly kiting the stock prices higher. Well, all of a sudden, that's come to an end because they don't have free cash flow anymore because they have such a build out. And so here we are. These companies are spending trillions of dollars over up to 2030. It's going to be $1 trillion, or well over $1 trillion of spending on this, and no one's real sure if they're going to make money or not. And then to make matters worse, with all this new AI they're going to have, all of a sudden it's wiping out huge numbers of other companies out there. Even Microsoft. If you think about Microsoft, well, if I've got AI, look, the worst code out there is Microsoft. Microsoft Windows. The thing is a monstrosity with millions of lines of code. It's flawed. There's backdoors all in the thing. It's just a complete mess. A decade ago, they should have redone the thing, made it simpler, more elegant. You know, the classic thing is the picture of Elon Musk tweeted out of the rockets for the Starship. You know, the first rocket was about 5 years ago, and it's huge, and there's wires coming off of it in tubes all over the place. It's just the most complicated thing. And then the next one's a little bit smaller, and there's less tubes. And then the final reiteration, this is just it's an elegant, very simplified rocket engine with materially less levels of areas of potential failure versus the first rocket. Well, if you look at Microsoft's code, it's the opposite. It started out somewhat elegant, and it's become a complete monstrosity. Well, AI can now rebuild that code. And from what I've heard, they're actually using AI to rebuild the code now. But the question is who else can come up with an operating system? People are kind of sick of Microsoft and paying all the money to Microsoft. But it's not just that. It's all types of things. If you look at things like CrowdStrike, and it was down 9%, which was a big anti. It's a big anti-hacking, cyber protection company. Well, AI now they can have AI through Anthropic. They're going to have a program that's constantly updating your things, so you might not need Palo Alto, or you might not need CrowdStrike or these other cyber companies. Cyber is going to be the big thing going forward. And it's just all these little software companies. All of a sudden, people might not need them if they can just go to AI and have the code built out for custom for their company and just go that route. So it's messing up the entire structure in the technology sector, which, as we pointed out earlier, at the beginning of this talk here, is that was up to 40%, over 40% of the S&P 500. So the S&P 500 is falling back. But on the other side of it, you have the industrials, the commodity companies, the material companies. Those companies, precious, they're all going up. Military defense, they're all going up, and we've seen a huge surge of those stocks up since the beginning of the year as institutions scramble to get out of technology stocks into those stocks. And so this is we're seeing a lot of volatility, a lot of opportunity to make money in it. But you have to understand where we're in the cycle. And as we said, look, this is kind of the end of the 60-40, hey, everybody get in the Vanguard S&P 500 fund and ride it up. That's pretty much over. Now it's going to be a tighter money regime to some extent. We don't need – the economy is undergoing a fundamental transition. We don't need all the money in the United States of America in the stock market so people can get wealthy. We need all the money, a lot of that money now going into manufacturing of chips, manufacturing of putting in electric generation plants, putting in defense plants, putting in plants that are coming in from other parts of the world back into the United States due to the tariffs. And so there's a huge demand for money out there. And this demand for money from AI, what did we just say? $885 billion from Google, $200 billion from Amazon. I mean, there's Apple, which is a less rich than there's Meta, there's Microsoft, all these guys. There's ChatGPT, there's OpenAI, there's Oracle. All these people need money. Okay, the electric companies need money to build out plants. So everybody needs money out there. So there's no longer an advantage to the United States of America to have every dime that every dollar go into the stock market to make your 401k higher, because the country is fundamentally threatened and fundamentally restructuring. on the fly, and that money is needed somewhere else. If a company raises money in the S&P in the New York Stock Exchange, let's be realistic. It's either a private equity company, or it's that wants to cash out, or it's a company that has it's a startup that's gotten built up. A lot of the investing's done in the private equity side now, and then they want, some of their shareholders want to get out. It's not the money raise it once was. And this is an important thing, which means there's less money for stock buybacks. This is why we're seeing the tech sector selling off. But there's been huge moves in the chemical sector, huge moves in the precious metal sector, huge moves in the defense sector. And we just looked at a little company we picked up the other day in the defense sector, a very exciting company. And so there's just all types of opportunity out there. It's just not in the same place. So when CNBC drones on endlessly about NVIDIA and Google and everybody else, understand that there's a whole new world opening up that we haven't seen in 20 or 30 years in manufacturing and build out. That's where the action is, and this is where it's going this year. So a lot of interesting things are happening. This is why we're seeing some of these things happening. The dollar is starting to strengthen, and so the market. Technically, the market is about even year to date, but there's been some very, very big winners in the market year to date in many of these sectors, as well as there's been a lot of losers. And so it's really the S&P 500 is up less than 1%, but there's lots of stocks up very, very nicely this year. But you have to be in the right ones, and this is why we talk about this. We write about this in the Max Out Savings. What we've been saying, commodities. We've been saying materials. The build out, $500 billion worth of factories coming in. These are all very exciting things happening out there to the U.S. economy that are fundamentally. This is a different. You have to go back to the 70s, 60, really the 60s, 70s, and 80s to really understand the world today. And it's a completely different world. I mean, we basically had we've taken financialization to the complete top. This week, some private equity companies, Blue Owl, is in trouble, and it's private equity. And one of the problems they're running into is they sold some funds to retail investors. We tried to stay out of private equity for our clients because we just don't like there's just too many people in it. It's interesting with private equity. There's more private equity firms out there than there are McDonald's. Every young MBA, they want to get out and start a private equity firm, so they raise money and they can buy companies. They can tell the companies what to do. And since they're so much smarter than everybody else, they're going to make a fortune. Or they're lending to companies. And again, these guys are, they've got their MBA degree. They've got 2 or 3 years under their belt, and they're ready to take on the world. Well, when you got that many people chasing data, I've actually heard, Jeffrey Gundlach of Dumbline made some comments that, they talked about the junk bond market. He said, look, it's actually in much better shape because most of the junkier credits have all gone to the private equity market where they can get a better deal from the private equity people. Well, now that sector's starting to blow up. Blue Owl Capital gated their retail funds and private equity, and now they've come up with a program to rescue, so they're going to give you back 35% of your money because they sold off the part of their assets. But what no one understands is they sold off the best stuff they could get, so they got par. They're telling them when they got par, well, that's the best stuff. The rest is all garbage. And now this group, Saba and Cox, are coming in and want to sit there and buy. They want to buy the rest of the fund. They're offering to buy it from investors at a 35% discount. Well, if you put the numbers on that, what that really means is after you get back your 35% at par that the company is going to sell off and get back to you, the rest of the fund is only worth 50 cents. Probably 50 cents or less, which is percent less, which is a huge problem. And so clearly we have a really big problem with private equity, and it. People forget back last year, Harvard got in trouble and needed more money. They've got like a $70 billion endowment, but the problem, they had to go borrow money through the bond markets because they couldn't access because it was all in private equity. This is a huge problem that's getting worse out there. As we said, there's a whole bunch of fools been lending money in that market. They didn't know what they're doing, and now we're seeing big losses. That's just one issue that's happening out there. So, again, you want to be in the right stuff. You want to be away from the junk. You want to be away from the problems, and you want to take advantage of the opportunities. And we're going to try to cover that and some of the exciting things happening in the United States today. We'll be right back right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
The Big 1070.
The Answer.
I'm Ted Gioka, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues. And that's where Ted Gioka can come in, and he can help. Go to maxoutsavings.com and schedule some time with Ted. That's maxoutsavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 103.3. The Answer.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
We're just talking about some of the big issues with the Blue Owl Capital, and a couple of their funds were sold to retail investors. The private equity is something they've been selling. They're really unloading on wealthy individuals, and then now they started taking it down to funds for smaller size investors, and it's been, a big thing. If you're wealthy, you want to get into the private equity because it pays more. What they didn't realize is there was a lot more volatility in the sector and a lot more risk. Because again, when you have I think the number is 12,000, but there's more private equity firms than there are McDonald's, and you have everybody chasing it around. It's become a problem. Now, here's the other problem: is right now they have all these private deals out there. There's private equity money and stuff. The problem is these people can't get out of it because AI. What did we just say about all the AI spending? Well, the AI companies are going to a lot of private equity people and other people saying, "Look, can you help us build out data centers?" So it's sucking hundreds of billions of dollars out of the market that's not that big, which is tightening liquidity even more. So this is going to be an issue going forward with private equity. It's going to get worse before it gets better. We might see some opportunities later this year to invest in it. For now, it's a problem, and it's something we want to watch. Hey, let's take a call from Charles at 1-339-1070. Welcome to the show, Charles.
Good morning, Ted. I got a question. I've noticed that Goldman Sachs is getting out of New York State. I think they're moving their headquarters to Florida, if my memory serves me right. Do you see companies like J.P. Morgan and all the rest of them, because of this mayor in New York now wants to raise wealth taxes now to 9.5%? and the, since he's promising free buses and all this stuff. Did you see the large financial institutions starting to move out? Because I just don't see how shareholders are going to tolerate staying there. The people like Jamie Dimon and all them, they may live in the Hamptons and all, but the bottom line is if the companies are paying an exorbitant amount of money for some of this nonsense, I would tend to think the shareholders wouldn't put up with this. What are your thoughts on that?
Well, no, I mean, I think we're seeing that happen. Goldman moved out some of their people out of there. The problem J.P. Morgan has, they just have a new, I think, $600-700 or $1 billion building they just put up there, which, they really have a problem. But I really think people want to get out of there, and you're seeing just a massive shift to Florida. To a lesser extent, Texas. Texas is really a better opportunity. I mean, honestly, if a hurricane hits down there, they're really going to be in trouble. And look, I mean, it's happening. I mean, these socialists are serious, and this reminds me of really Greece in the late 1940s, 50s, or Italy in the late 60s and early 70s, where the communists came in and they were really causing huge problems, socialists and communists, but they're really very radicalized. And I think what's starting to concern people is that these people seem very radicalized, and people don't feel safe if they're on the other side. Never mind the taxes and everything else. I think it's going to continue. Palantir left Denver, didn't say a word about it, and moved their offices to somewhere around Miami, I think Miami area. They moved so quickly that their headquarters is in one of these temporary office places until they can get everything bought up. And so this is becoming a bigger issue out there. And
it seems like Virginia may be the next one because of this Spanberger woman that got in there, and I mean she's raising taxes left and right, and I mean I think she had the support of Northern Virginia, but again I think there's a lot of military type companies, shipbuilding and all that are probably domiciled in Virginia, and I can see those people getting out of there to some extent because I think it's going to be the same playbook. I don't know.
I mean, I think that's what and Charles, it's two things. It's the taxes. Look, most conservative types can kind of get along with liberals pretty well. They kind of roll their eyes and stuff, and we're happy to debate, but they can get along. The problem with the liberals and the socialists, these more radical types, is they can't get along at all. I mean, they hate the other side, and that's and so understand it's not just taxes. It's the problem of feeling unsafe if you don't support them. You might be tossed in jail, or you might be beaten up, or something, or the malicious taxes put on you just because of who you are, and that's what's starting to frighten people. I mean, you had Susan Rice out the other day, former Obama administration, very powerful Obama administration official, saying, well, look, when Trump's gone, there's going to be payback time for these corporations that support Trump. I mean, and so these companies are almost being forced out of these radicalized places. I mean, I really think I think you really have to go back, and hopefully it's like Italy, because they got it under control. I mean, you worry you could see something like a civil war or something. And the Civil War, I've heard stories in the Civil War. I've sat down and listened to some real fascinating things. And near the end of the Civil War, just what a complete unmitigated disaster it was. And where people, it was just unbelievable. And it was real interesting. I mean, where my mom's from is originally in Georgia. It was, we still have the family place there, and I still hear stories, and it's just like unbelievable. And we seem to be drifting into that, and it doesn't appear to be the Trump people. It's just this completely radicalized group on the other side. I think they're going to have to go after the money that are ginning these people up and stuff, and really
Well,
there's going to be a
there
problem.
is that. They pretty much, I think, have concluded that a lot of that rioting and all that went on in Minnesota could be attributed to that tech mogul that moved to Shanghai. That what's his name? Neville Singham is his name. And I mean, the guy was a billionaire and funding all of the. Even I think the president even said, "Gee, those are really nice protest signs." He says, "I'd like to be able to find out who." Well, I mean, if this is some billionaire living in Shanghai, China, and he's, I mean, what can you say if the CCP is helping him bankroll this stuff? I mean, I think a lot of that's got to be addressed, and I don't know where the Congress is and the Senate is on this stuff. I mean, these people. I don't know. I think that's the bigger problem more than anything is we got.
Yeah, Congress is pretty much ceasing to function. It's been years since they don't even do a budget anymore. They just do a reconciliation because they can't. The only way to get Congress back to functioning is they need to get rid of the filibuster. And then I think strangely enough, I think it actually will force people to sit there and be more conciliatory to get stuff done. And so we'll see. But anyway, good questions, Charles.
Sure. Okay.
Yeah, I mean that's what we're dealing with. A lot of people, a lot of companies now. This is good for Texas, Florida, places like that. By the way, I noticed that Florida's getting rid of their property taxes. It'd be nice if the state of Texas could do something like that. But anyway, that's another story. A couple things we wanted to touch. The tariffs came out. The Supreme Court ruled against the tariffs. A couple thoughts on this. This thing should have been settled 6 months ago or 4 months ago, and if it was a problem, the Supreme Court should have said it and come out with it so we could straighten up. They've given Trump there's a number of different other tariff statutes Trump can use. He put a 10% tariff on all products instead. He's just raised that to 5% more. So it looks like it's going to go back up. There's like $158 billion worth of tariffs we've collected. And the question is, do they have to pay that back? And the corporation's saying, yes, okay, well, fair enough. Secretary Bissett just said that this is going to be a massive welfare program for corporations. I mean, candidly, I think Congress should immediately pass a law. If anyone gets the tariff refund back, they need to refund it back to the consumers. And so people like Costco, they're suing to get this money back. I'm assuming they're going to be paying it back to their members, which is easier for them to do and to refund it to their members. Because it should flow right down. It shouldn't just go to the people. I mean, and if the corporations want to play this game, then they need to pay it back to the consumers. But a couple thoughts on this. Look, President Trump has very skillfully used this to get back. Our number's been $500 billion worth of factories, and I think that's a reasonable number that are coming back to the U.S. What he's done is he said, look, how can we get the country growing again? We've got a $39 trillion deficit, trade debt. Our deficit is about $2 trillion a year. We're in severe trouble. The financial system is going to collapse because the dollar is going to collapse, and we're not going to be able to borrow money unless we do something. So he comes up with a 4-point plan. We're going to cut spending through Doge. And Doge was able to cut spending. Congress, which is virtually non-workable, has been able to cut virtually nothing. But they're cutting spending. They're going to grow the economy through all these factories coming back, which is more income. They're also coming in, and they're going to cut interest rates on the short end to reduce the interest rate costs, which is over $1 trillion right now per year. And then they're going to get tariffs, which is going to help push the factories back, which is going to create more growth, which is going to create more taxable income, but also as they grow. But the tariffs are going to generate income to pay down the deficit. So it was a 4-legged stool. It was a very good idea, but the problem is we need the income from the tariffs to pay down. Now, what he did is he took the tariffs. He said, look, we have to somehow do what China did. China went and kept all the imports out of their country. Then they exported huge amounts of stuff. They brought the factories into their country. They didn't have tariffs, but they had tariffs. But what they did is they stole the technology. They copied what we did, and then they undersold us. And they convinced American corporations that they could increase their margins. American corporations have the highest margins in history because they've shipped all the stuff overseas, but it's been disastrous for the United States. The problem is it's hurt the country, it's hurt employment, it's hurt working people, and it's become a national security problem. As we saw during COVID, we got cut off from PPE, the protection for COVID, because the Chinese needed it for themselves. And if we go to war with China or someone else, we could be further cut off. So they're bringing all this stuff back. So he dusted off the same playbook that China had and put it and is applying it to the United States using tariffs instead of stealing technology. So this is all happening. It's all good. The Supreme Court's kind of throwing a wrench in it. He's going to go around the Supreme Court. I wouldn't have criticized the Supreme Court as much. I would have said, look, guys, you could have told us this ahead of time. You need to move quicker, and we could get something straightened out. But the Supreme Court also, through some of the dissents, keep in mind, I think there were 7 out of 9 dissents. I believe that was 7 out of 9 judges were dissented. Or they gave a separate opinion. Some of them consented, some dissented. But the dissents gave the way that, hey, you can do the tariffs this way, which Trump is doing. So these tariffs are still going to be there. We need probably $250 billion worth of income to force the factories back here, but also to pay down our deficit to stabilize our annual spending deficit. So nothing's going to change. Trump minutes ago has already raised from 10% to 15%, raised 5% more on the tariffs coming in, and we'll see how that goes. Again, it's not the biggest issue out there. To us, when it comes to the markets, what we're watching right now, and we're going to cover this. Actually, we're coming up near a break, so I'm going to cover it at the next segment. Is going to be is what's going to happen with Iran, what's going to happen going forward. Our base case for the economy is we're going to have a reasonably good economy this year. This is what we've been talking about. We believe the stock market is going to be much more volatile this year. We also, which appears to be what's happening, and so this is kind of what we're looking at here. Tell you what, let's take a break in here now. I want to cover some of the earnings came out in the precious metal stocks. I want some real interesting things came out there. I want to really talk about this build up with Iran. Some very serious things are going on there, and where do we go from here? We'll be right back after this quick break right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
Where can you get the truth? Salem Media Group is the place. Townhall.com, hotair.com, redstate.com, bjmedia.com, twitchy.com, and salemnewschannel.com. You can count on the full story from the Salem Media Group.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We're talking savings, investments, your retirement on the show. Yeah, I was talking to some friends of mine this week, and they're like, Ted, you're always so bearish. And I'm like, well, and I thought about it for a second, and we tend to be pretty bearish. And I said, well, look, how I was able to beat the market last year, beat the market this year substantially. We've really over the last 5 years or so, I was just running some numbers. We've done phenomenally well. And it's not that I'm that bearish, but I'm always looking for a potential problem because I don't want to get caught in the problem. And so, but when it comes to money and it comes to retirement, your retirement money, you want to half of the battle is avoiding the problems. And so if you can always be looking for the problems and kind of stay out of those potential problems, then you usually come out ahead. And if you can try to find, hey, what looks good, what seems to have less problems, what has the best opportunities, and go that route. I think that's just our philosophy. We tend to be value investors, and so we actually like when things go down because then we can buy things cheaper. When things are super expensive, it's harder to invest because we're just not going to throw a bunch of money into the market hoping it's going to go up forever. And so. That's just our style of investing. We tend to be, we tend to really, we like value. And so we're always trying to find value somewhere. When everyone's telling me how bad something is, we're over there combing through it saying, hey, where's the opportunity? Whereas when everyone's telling you how great everything is, that's when we tend to be a little more, look, money is made. A lot of money is really lost in big bull markets. In bear markets, a lot of money can be made. People don't understand this because they tend to panic or they tend to become overly exuberant at the top. Yeah, and that's sort of our thinking there overall. And so that's what sometimes when you hear some of this stuff, that's what we're trying to do. We're trying to. It's like we're talking about private. Look, I think later this year, next, we're going to see some good opportunities in private equity, but you got to shake out the market. I talk to these private equity people. We have them in because want to see if there's something we want to do with our clients, and they're like, well, the market was down. This is years so back. The market was down 15% or in the first quarter, and our stuff was private equity was only down. It was. Tariff tantrum last year, the market dropped almost 20%. And they go, well, look, the market's now 15-20%. But the private equity, our stuff was only down 2 or 3%. Well, I'm like, that's because you're not marking it to the true market. And sure enough, here we are almost a year later to the day, and private equity is blowing up all over the place because they weren't correctly marking their values. And so you want to look for that. And one of the things that's going to come out of these private equity thing is they're going to have to get much more. These companies are not marking their assets correctly. They're sort of they're thinly traded, and they're giving the investors the idea that things are doing much better than they really are. Now, a couple of things. I tell you something that is doing quite well. Interesting. We listened to the precious metals conference calls for Hecla, Barrick, Pan American, Kinross, Newmont. There's a bunch of them. But a couple of things jumped out in the things. Newmont expecting $2.50, $2.05. They came at $2.52. Again, blew out the numbers. Big win. Kinross was 59 cents. They came in at 67 cents. 59 expectations. The expectations for Pan American were 86 cents. They came in at $1.11. A couple of thoughts jumped out. I wasn't super impressed with the Newmont's gold production is going to fall 7-8% next year because they're moving through some different. They have to strip some more mines to get some, and then it's going to go back up again. I wasn't impressed with that. Pan American's projecting 8% growth in gold in silver production next year, which is very positive. So that's good growth. Kinross has got really good growth. Barrick, it just seems that their costs went up more than expected, but they have a huge discovery in their 4 Mile near the 4 Mile mine. That's kind of jointly in it. They own it, but it's in a joint venture with Newmont. That's just a massive discovery, probably the biggest discovery of this century so far. And so that's a big opportunity. Their costs are going up. They've not done a good job with their money. I think there's got to be some type of restructuring at Barrick, so we like that. A couple thoughts. A lot of these companies, the gold they about $4,200 an ounce, and is what they got for the fourth quarter. So I just we had $2.50. They were expecting $2.05. They got $2.52. It was at $42 an ounce. Well, right now gold is $5,100 an ounce, which is about 22% higher. So the numbers are going to even be better for the first quarter. So these guys are really turning in some big numbers, and the PE ratios aren't real strong on the gold sector. And even if gold falls back down, even to $4,200 an ounce, you're still looking at very good numbers. Silver, most of them came in about 58. I think it was Hecla and Alamos. They got like $10 higher. And people are kind of wondering, like, how did you get that? And it looks like someone was paying them extra to get their physical gold, possibly because there's such a shortage of physical silver, which is pretty bullish there. But very good numbers across the board. And again, these numbers for silver is actually about 46% higher today. Silver's over $80. I was over $80 on Friday. So again, really good numbers in the sector overall. And silver is higher, so we don't need, for the precious metal stocks to do well, they don't need silver to go to 100 and gold go to 6,000. If it just stays right here where it is, numbers are going to continue to go higher. If it sells off some, they're still going to be reasonably good shape. Something to kind of think about in the sector right now. Silver actually closed Friday at $84.50 an ounce, which is again pretty high. Keep in mind it peaked out at 120, and then had that collapse in one day. But there's been 5 years of deficit in silver. Silver is a critical metal for AI, for solar power, for electrification, all types of things. There's a shortage out there. So the numbers look good. We still like the copper. The material sector continues to look good, and the valuations are reasonable. Now, The big thing that's happening out there right now is the buildup, and this is what we're watching closely. We have a hedge on that could come off for our clients. We're trying to be cautious. A couple thoughts on this Iran situation. This is what I'm looking at: is the U.S. is helping Israel. Okay, Larry, want to get a quick call in. Hey, Larry, welcome to the Mac Show.
Hi, Ted. How are you today?
Doing well, thanks.
So I've noticed there's another sector of the market that seems to be doing pretty well right now, and that's the shipping. These companies that run these big LNG ships and stuff like that.
Yes.
Can you tell me what's going on there?
Yeah, I like the sector. It's doing really well. The shipping's probably a pretty good way because there's such a demand for it, and there's a lot of gas fields coming in around the world. They're going to need LNG to move it. So I haven't looked at the shipping sectors themselves, but I do like that sector because there's really a good growth curve. I'm not as bullish on the companies that actually own the ports that export it, that condense down the natural gas, that liquefy the natural gas. I'm not as bullish there because I think there's going to be a lot more competition for the gas from other parts of the world. But the shipping, no matter where it's shipped out of, the ship should do well because if the Louisiana gets too expensive and the Angola gas is cheaper or elsewhere, Tanzania, they still have to ship it by the ships. The ones we like for the natural gas sector are the U.S. natural gas stocks because there's such a demand for gas, for electricity. Particularly, I like the Marcellus groups because I think there's less competition. I think they're going to open up more pipelines and there are more long-life reserves over there.
Okay. Thank you very much.
Okay, thanks. Good question. We like gas. So we've got this the Iran situation. A couple thoughts. The U.S. is helping Israel right now. Israel knows that if Trump loses the midterms, they're not going to get the support. Their support is dwindling to some extent. The window is open for them to finally do something about Iran. I don't think they're going to keep their foot off the gas. I think they know they have to do this right now. They're not going to get another opportunity. So they're going to be very tough and want a good deal. The United States has moved over a large amount of ships and aircraft. To put it in perspective, this is the biggest buildup in over 20 years from the Iraq War, not the recent war with this little bombing we did with Iran, the biggest since Iraq. To put some numbers, some of the numbers, I think there's several hundred F-35, F-22s, F-16s, and F-18s moved over there, over several hundred. There's 85 tankers, fuel tankers have been moved over, aerial fuel tankers to keep the fleet up in the air. 170 ships, 170 aircraft, transport aircraft. We have two carrier groups, the Lincoln and the Ford group over there. This is a massive armada and Trump calls it armada. It genuinely is. You can't keep that up for very long. I mean, that's a huge supply situation, and they're going to do something. I think. The one thing is they've never been able to take the Ayatollah out because you don't want to take out a religious figure. But what's happened is the majority of the Iranians are no longer even that religious over there because they just hate the Ayatollah in their kind of their draconian Muslim view of Islam. And so I think there is that opportunity to try to take him. I think ideally the model that Trump would really like would be to have the Ayatollah leave and his people leave. I think they've talked to the Iranian Republican Guard, and they've said, look, guys, you guys control a lot of industry in the country. You've become very wealthy. We have no problem with you staying. We want the Ayatollahs and their crew out of there. We want you to modernize, and we want you to release the political prisoners, peace with Israel, and get rid of your nuclear and ballistic, and we'll bring you into the world economy. I think they've been told that. That's my guess. I think if the Ayatollahs hold tight, there's going to be bombing. You don't know what could happen. It could be a pretty severe thing. The one thing that is different from all the other wars over there is the Chinese and the Russians are actively helping them. And the problem with this goofy Iran-Russia Ukraine-Russia war is that kind of we set it up so you can go target Russian assets and give all the information over to the Ukrainians to target them. Well, the problem is the Russians and the Chinese are going to do the same thing to us now. And so I think it's a dangerous situation. I think the market's near highs. I think you really want to be cautious because I do think it's all if you can clean up Iran, you can totally change the Middle East and really grow the entire world economy. This is an opportunity for everyone, including the Iranians. But it's not an easy thing because these mullahs have been hardline. They're old. They're entrenched, and they're building up stuff. The Russians and the Chinese have sent in special anti-aircraft stuff and all types of things they want to test on the Americans as well. So this is going to be a tough thing. This is something we want to watch, and we want to be a little cautious. I think something happens in the next couple weeks, and I do think you want to be a little cautious. If we can get through this, I think there's a lot of opportunities in the markets going forward, but that's just something we want to watch. Now, a couple things I just want to touch base on. We're going to be writing about this in our Max Out Savings Report. We send it out about once a month. We've just been so busy with just really a lot of things happening in the markets and staying on top. We're going to get this report out to you. We bring a lot of interesting things that other people aren't telling you in this report to try to help you understand the world today, protect yourself in retirement, and understand the world today. It's called the Max Out Savings Report. Just go to our website, maxoutsavings.com, sign up for it, and we'll send it out to you. If you're interested in having a Max Out Savings Advisors manage one of your 401ks, an old 401k, or you're retiring, that's what we do. We use Charles Schwab to custody the assets, and we manage it for you, so using our value investing approach. If you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com, and you can get the phone number, email from there, and just drop me an email or give us a phone call. We'll set up an appointment here in Houston, Texas, and get you set up. But at least sign up for the free newsletter. And by the way, you're not going to get a call from us. We just send out that newsletter. That's all the newsletter is to help you out. And our new one's going to have some stuff on taxes, some of the tax changes, as well as what's going on with the tariffs, the war, and everything else out there, or hopefully non-war. So anyway, if you get a chance, go to the website, maxoutsavings.com. Also remember our motto and philosophy, which is to save aggressively and invest conservatively. Save aggressively, invest conservatively. That's the key to building up wealth over the long term. And by the way, we're going to be having our podcast on YouTube. They're on the website at 1070 KNTH. I'm going to be on YouTube, so it's going to be more. We're going to have some video as well on there. So a lot of exciting things are starting to happen with the Max Out Savings. We've been on for over 20 years, have a huge following. We're going to expand that. We'll see you next week right here on the Max Out Savings Show.
Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.
AM 1070 and FM 103.3. The Answer.